morning everyone and welcome to this new video. Today we are talking about one of the most crucial aspects of any company's success, managing cash through working capital. I often hear entrepreneurs and managers complaining about liquidity problems despite having orders in progress or outstanding invoices. The truth is that many underestimate the importance of net working capital. So in this video we will see what is working capital and what are its key elements, how to calculate and interpret it correctly, common mistakes to avoiding it, and practical strategies to optimize it and improve the financial health of your company. So stay with me until the end because I will show you many practical examples using Excel sheets to monitor and improve your company's working capital in real time. So have you ever had customers who pay late, warehouse stocks stop for months, or difficulty in meeting operating expenses? Write in the comments down below. I'm curious to know your experiences. Let's start with the definition. Net working capital is the difference between current assets and current liabilities. This value tells us how much cash the company has available to meet its short-term expenses. Let's see the main elements together. Current asset is composed by cash, account receivable, inventories, while current liabilities are payables to suppliers, short-term loan installments, operating expenses. The net working capital is different from cash flow. While cash flow measures the inflow and the outflow of money, working capital measures the company's ability to manage its resources in the short term. Let's see a practical example. A company with current assets of 100 euro and current liabilities for 80,000, calculation is 100 less 80, 20,000 positive working capital. This means that the company has good liquidity to cover its short-term expenses. Why is working capital so important? Having positive working capital is crucial for business survival and growth. Let's see the main reasons together. Financial stability. It avoids problems in payment and ensures the smooth operation of the business. Business growth. It allows you to reinvest in projects, expand the warehouse, or launch new products. Better access to credit. Banks and investors view working capital as a key indicator of corporate health. Common mistake. Many business owners think that increasing sales is enough to solve liquidity problems, but if customers pay late or stock is too high, the problem remains. Now let's see a couple of examples. Case 1. Let's think a company with receivables to be collected of 50,000 euros, inventories of 30,000, and payables to suppliers of 60,000. Calculation is quite easy. 50 plus 30 minus 60, 20,000 positive. This company has a balanced management of working capital. Case number 2. Now think a company with 20,000 euro in credit, 10,000 in inventory and 50,000 in debt. Calculation 20 plus 10 minus 50, 20,000 negative. Here we see a problem. The company doesn't have enough resources to meet its short-term debts. Prepared here an Excel file to monitor the trend of working capital in the first 6 months of the year. Obviously, there are much more performing tools than Excel, but in this case, it looks fine for synthesis needs. Now we can see the strategies to optimize working capital. What are the best strategies to optimize the working capital in a company? There are many, and we list only the main ones. Strategy number 1. Reduce the time it takes to collect receivable. Offer discounts for prepayments. Use tools such as factoring to cash out faster. Strategy number 2. Optimize inventory management, for example by using just-in-time system to reduce inventory, especially when we have to eliminate the obsolete or low turnover inventory. Strategy number 3. Negotiate longer payment terms with suppliers. Having more time to pay suppliers improves available liquidity. Strategy number 4. Constant monitoring. Use financial management software to control flows in real time. Common mistake. Avoid drastically reducing inventories just to improve working capital. You risk not having products available to customers, because working capital and inventories share a kind of complicated love. Inventory is crucial for ensuring business continuity and meeting customer demand, but it can hide some financial pitfalls. Why? For example, resource lockup. The higher the inventory, the more capital is locked up in assets that not immediately generate cash. Obsolescence risk. Products that have been unsold for too long can depreciate, leading to devaluation. Holding cost. For example, storage or inventory management involves significant expenses. Selling at a loss. If a company needs immediate liquidity, it could be forced to sell off its stock at a price below market value, resulting in a capital loss. So, to better analyze the impact of inventories, we can use the acid test, which excludes inventories from working capital, focusing only on the most liquid asset, such as cash and trade receivables. The formula is this one depicted in the picture. Practical example. Imagine two companies with the same total working capital, 40,000 euros. As you can see, in the second row, the working capital for both companies, A and B, is 40,000. But stocks are not immediately liquid sometimes. If you calculate the asset test for both companies, it turns out that the company A gets a value of less than 1. This means that if the company were unable to sell its stock immediately, it would be in serious financial difficulty because it would not be able to meet its payments. On the contrary, company B, with a significant lower stock value, is perfectly capable of meeting its short-term payments with an asset test of 1.5. To avoid a situation with solvency, the company A could try to sell its stock with a loss of 20%, for example, thus collecting 40,000 instead of 50,000. Now the asset test has become higher than 1, so the company, in the short term, has solved its problems, as it's back in a positive liquidity situation. However, sometimes solving problems in the short term means creating bigger ones in the long run. In fact, now the company finds itself completely out of stock and potentially in a situation having to buy in a hurry to be able to fulfill order at this point, perhaps paying for it at a higher price than the market price, further reducing the overall operating margin. Company B could have problems as well, because it fails to quickly increase inventories to sales peak. In this case, it could find itself in a situation where, in order to avoid loss of turnover, it would be forced to buy inventory at higher prices than previously agreed, also reducing the operating margin. As a conclusion, these examples show that having high inventory isn't always an advantage. Optimal working capital management requires balance between liquidity, receivables, and inventory. Poor inventory management can lead to sell-off, resulting in economic losses and reduced business profitability. Common mistakes to avoid in working capital management. Mistake number 1. Confusing net working capital with cash flow. Mistake number 2. Ignoring stock, especially obsolete stock, that is hugging valuable resources. Mistake number 3. Not monitoring your financial situation regularly. Optimal inventory management has made the, for example, IT company Dell a success. As you know, Dell is a leader in the market for the sale of assembled PC with home delivery. This is essentially thanks to a perfectly integrated logistic chain that allows it to have a very lean warehouse, thus avoiding problem of obsolescence, which has a very high incidence in the tech sector, and at the same time allowing it to deliver its computer all over the world in a very short time. As a conclusion of this video, we have seen together that working capital is and why it is important and how to optimize it with practical strategies. Now it's your turn. Start calculating your company's working capital and monitor it regularly. If this video was useful to you, leave a like, subscribe to the channel and activate the bell so you don't miss the next content. And if you want to learn more about the topic, Find my contacts in the description. I will be happy to help you improve the financial management of your company. See you next week.